Good night, good morning, or whichever time you're watching this video clip. Now we're continuing to look at partnership, and we'll look at the entire question and the exam question to give you a better understanding of how to address when address issues when given situations with partnerships and taxation. Now look at this data sheet. Now this is the data sheet that is the first thing that you will see on your on an exam paper when you're doing taxation too, right? These are the original cost of motor vehicle annual tax benefit, which we would have explained to you before some other time in class prior. And now it says figure in brackets is the value of the motor vehicle emolument, where taxpayer has what over 50% private use. Other figure represents what value in taxpayer has what, up to 50% private usage. These are the cost of the vehicles, and these are the what just which is whether it is up to 5 years old, over 5 years old. Alright, those things are dealt with other were dealt with otherwise. Alright, income tax threshold now. Now the threshold for different years. Observe this though that for 2017 the effective threshold for 2017 is what 1,375, 140. You will see that somewhere else. When you see it, you know where it came from. Alright. So note these things if you could if you so this I can pause the video, write them down for me. No problem. Pause the video, write this down if you don't mind. Thank you very much. Now I'm gonna go to the example now itself. Example says Daniel and Leslie operate a partnership. They share profits and losses equally. The profit and loss account for the year ended December 31st, 2017 is as follows. Alright. Now you have the gross profit is 4,525,000. Then your less what? Salaries and wages, general expenses, bad debt, motor vehicle expenses, insurance, depreciation, net profit. Sorry, you add up all these now, subtract these now from this, and you get the net profit. So this is the net profit which you will start your what? Adjusted profit statement with, right? When it comes to that point. This is just a question itself. Alright. Then you have appropriation account, partner salary allowances, Daniel Leslie. You have interest on capital, Daniel Leslie. Share profit 50% currently, which is 265,000. 265,000. And this figure is not really correct, it seems, because there's no 50% of this could be this. So this is wrong. Alright? You would see that this is really wrong at present. Good? Now, other information which is very important to note, the partner's salary and interests are as given in the appropriation account. Very important to note that. What will happen there is a question you must ask yourself. Based on what you have, that you have to read over the material that was given to you today. Good. So look at this. Remember this. Let's go a little bit for this. Let's look at something here. So now salary now. A salaried partner who does not participate in profits is an employable business, right? Now in this case though, a different situation. A salaried partner who by agreement receives a monthly salary, sometimes referred to as a salary allowance, and participates in the profits is receiving what? An appropriation of profits, albeit as regular monthly installments. This is usually done so that a partner who is doing the work on a daily basis is remunerated for the work, and this is usually treated as a first charge on the partnership profits. For income tax purposes, the annual amount paid to the salaried partner is an appropriation of profits, and if this salary had been debited to the profit and loss in the accounts by being included along with other payroll amounts, then the gross salary of the salaried partner has to be what? added back to the accounting profit. Therefore, in this case, you will see that the partner's salaries will be what? Added back, because this is the partner's salary and interest are as given in the what? Appropriation account. Based on what this says, they should be what? So for income tax purposes, the annual amount paid to the salaried partner is a proportion of profits, right? And if this salary had been debited to the profit and loss in the accounts by being included along with other payroll amounts, then the gross salary of the salaried partner has to be what? Added back to the accounting profit. So the partner salary and interest are as given in the appropriation account. So what is he saying is that they were not debited to the profit and loss, right? If you look up top, you realize that there's nowhere here where salaries where these the salaries for the partners were included in the calculation of what net profit. So therefore, it would not be added back in this case. All right. Now, as there is an interest, we'll do that later on. All right. Included in general expenses as the following amounts are the following amounts: subscriptions and donations, $50,000. A breakdown of the subscriptions and donations shows $30,000 to the Chamber of Commerce and $20,000 for magazine and service club subscriptions. So that means that some of this amount should be what? Added back, while some should be taken out, which we will see as we go along if it needs be. Electricity of 25,000 for the partner's private residence. Bad debts totaling $100,000 are in relation to a debtor who is bankrupt, and the remaining balance is a general provision. Annual allowances for the year of assessment 2017 amounted to $240,000. Daniel is 58 and Leslie 67. Alright, let's look at it now. Required says compute the what? Income tax liability of Daniela and Leslie for the assessment 2017, stating all necessary assumptions. Now, I will ask you to pause the video, write some for me, please. Pause the video, write some for me, please. Pause the video, write some for me, please. Let's go to the solution now. So heading now is Daniel and Leslie profit adjustment statement and annual income tax computation for December 31, 2017. Now, as I said before, as a customary, we would start with what? Accounting profit as given, right? Then we would what? Add back depreciation of 135,000. Then you would add expenses not allowed, which include provision for the bad debt, subscription donations, which were made to the magazine, and also electricity expense. Now look at, there are some notes here to note. Note 1. We'll look at note 1 already. Let's look at note 1, 2, and look at these notes now. Alright. Note 1 says, bad debts incurred in the business are what? Allowed. However, a general provision what? Is not allowed. So therefore, the general provision for, so 100,000 are allowed, but it will be 100,000 out of this. The remainder, which is 250,000, will be a general provision, which is not allowed. Alright. Then you have subscriptions and donations now, which are not subscriptions and donations which are not approved by the Commissioner General are added back. Now in this case, the amount contributed to the Chamber of Commerce would have been allowed, but the amount contributed to for magazine and service club subscriptions is not allowed. Alright. So that's the reason why the 20,000 is added back. Alright. Now we look at electricity expenses now. It says that 25,000 electricity expense is for the what? Partners private residence. That is not categorically not allowed. What is what no students so say so private electricity expenses are not for business purposes. It is an appropriation of profits and is not allowed. Alright? Cool. Add up all these now, you get 26,000. Add them up to these now, you get your adjusted net profit of 3 million. Sorry, you get 3,165,000 right there. Then you would what? Less your capital allowances, and those are what? 205,000 for 2017, and that will give you now your adjusted net profit of 2,925,000. That's the that's their adjusted net profit. Good. It's a profit which you look to share between the two folks. Alright, good. Alright, let's roll on now. Alright, so let's look at salaries now. So this part now is where you compute income tax for each individual, right? First you look at is this kind of is done differently from a normal way, right? So what you would do first in this case now, you put in the totals, right? Good. And that would be salaries of each of 15,000 and 25,000 for different persons. Then they put in the interest and capital now, which should be 700,000, 350 for each person. Now, what you do next is that you to get a share of profits now, you would subtract the salaries and interest and capital from the adjusted profit to get the what? Share profit of 685,000, and they divide it by what? 50%, and they end up with 342,500 for share profits for each person. Alright, that's how you do it in this. That's how you do it in this case. Follow me. So watch and follow, please. Also, we should know that depreciation is not allowed. It's not an allowable deduction in computing taxable profits. However, capital allowances are deductible. Alright, which you have seen already. Alright. So we go again. First thing you do, you start your salaries of 1,540,000. You divide that in the twos. This 50% doesn't really refer to these two, It refers to the share profits technically. Alright, good. Because this was incorrect, so you have to try to correct this one that was there before. Alright. Alright, so you have salaries now as you differentiate them as is given. You have appropriation account. So technically this portion of the question is really adjusted appropriation account. Alright, good. Now then you have interest and capital, 700,000. Now to get the 685,000 share profits, you add these two, subtract it now from the 2,925,000. Then you get 685. There's divide them 50% each, and you get the total business profits here, which is separately figures right here. Now you're gonna less allowable deductions now. Less NIS, which is $75,000 based on 2017 calculations, which was given before. Now let's look at the age exemption, because let's is what 68 years old, of $80,000. So this is 67 years old and is not required to pay NIS. She is entitled to an what? Age exemption of $80,000. Alright? Um, then after that, now you subtract everything. You get statutory income. Then you would less the threshold. Now you will see that there is no pension exemption because there is no pension income. Alright? You less the threshold, which is 1375 for both for the year. And that would give you, for this one it will be zero, so there will be no taxes paid. But for Daniel now, the taxable income would have been 57,360, and the tax would have been 25% of this one. Would give you 14,340. All right. Pause the video. Write this down. 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 Pause the video. Write down. Pause the video. Right. Thank you for watching. Do enjoy the rest of your night or day. God bless you.